All right, people in the class, welcome to the session. I guess we are live. Someone please confirm if you can see me, hear me. So, who all do I have? Everyone in the class, welcome to the session. Very good afternoon, very good morning, very good evening, everyone. Please join in. Hi Shrividya, how are you? Other live people in the class, kindly join in quick. Chandana, very good morning, very good evening, very good afternoon, as I say. Okay, who else is here in this live class? Shanar, hello, all right. Ramya Sneha, were you there yesterday? I don't think so. Seems I'm talking to you for the first time. Hi Soumya. Who else is here in this live batch? Abdul, were you there yesterday? Yash, hi. Robin, hi. Robin, I think even you were not there yesterday. I think so. So, is there some issue people are facing to join? Purshi, hi. Then Athena, hi. Prachi, hi. Others in the class, quickly join in. So, well, I think I have to wait for a minute. It's too late to share the link with everyone. So, we'll wait for a minute. Let everyone join in and then we talk. Okay. Robin, I was there but the channel was not there to text. What do you mean? For us to be able to text, the channel has to be there, is it? Okay. I didn't know so. I didn't know it. Gauri is here, Gopi is here. Hi everyone. How is everything going on? People, what do you say? So, what were you doing by the way? What is the schedule? What do you study in the first part of the day? Miral, hi. Everyone in the class, what goes on till this point of the day? Audit, FR, group 2, what does it, how does the day look like to you? Yes, audit, the pain point actually, right? Others? So whosoever is joining late, okay, kindly drag the session to the latest live point. You have an option to track it, right? You have this timeline in the red color timeline in the on the YouTube. Gaurav, power cut means? So you're joining from phone, is it? Shravan, good evening. Deepak, good evening. Okay, Gaurav, cool. But that is the dedication we need actually, right? Happy evening, Soumya. Happy evening. So everyone, shall we all, people in the class, proceed? Appaji, good evening. So I think we have waited sufficiently for everyone to join in and now we need to get started. How many of you, people in the class, open your book again after going back to the home? After going back, how many of you literally ended up opening your book? How many of you literally went through the OutNotes? I had shared the OutNotes yesterday in the class itself, and I would also try to put it in the description of lecture 1, 2, and 3, the soft copy of OutNotes and OutScanner, right? Those who have not printed them, please download the latest one. If you have not printed it yet, okay, please download the latest copy from the Telegram channel and then get it printed if you are looking for it. Okay. So great. I want you all to be everyone in the class energies. I need your energies for the next 2 hours and we will then be able to make some fun. How many of you remember the discussion we were trying to pick up yesterday, everyone? We started our discussion with different kinds of rates of return where I explained to you the difference between required and expected, right? So expected was how much you think you will be able to make, required is how much I need to make based on the risk involved. And related to this discussion, I explained you what are the types of cash flows available in the market. One is nominal, which are the future cash flows which has the effect of inflation included in it, whereas the real is estimating the future cash flows without the effect of inflation. What do you all everyone say? Do you remember this, people? Yash, did you drop the lecture yesterday towards the end? Is it? Or you genuinely need a revision? What do you say? So people, Ishwari, are you my batch student? You are asking me the most difficult question actually. You are asking for my estimate of November 24 exam. If I try to give these estimate in the first two lectures of the class, then obviously the number of lectures that will be sold for this power batch will be too high. You have some confusion, we will discuss it. Ishwari, you have enrolled it today. Okay, great. So obviously no one can predict the paper. But throughout our preparation, we'll try to focus on the questions which are more exam oriented than the questions in general. Okay. But paper prediction, if I really start to do, a lot of students would start to follow me. Okay. But that will be a fake following because that's a fake prediction actually. If anyone ever makes it. So great. People, we are getting started. All right. So how many of you remember yesterday we had a discussion that if I want to predict the future cash flows, people in the class, please be here. If you want to predict the future cash flows, for example, you have predicted these quantities and you have also tried to predict the prices. So we have two prices available. Sir, if there won't be any inflation, the price will be same as today, which is 50-50-50. However, with an assumed inflation rate of 10%, the prices will be these 55, 60.5 and 66.5. Right? Now, suppose I take the, how much will the actual price that you will receive at the end of first year 55. The actual price you will receive at the end of second year is 60.5. So now suppose that if I want to predict my actual revenue at the end of first year, which will have naturally included in it the effect of inflation, which is 100 multiplied by 55, such a cash flow is called as nominal because it has the effect of inflation included in it. Whereas if I try to predict the second year's cash flow 100 into 60.5, 110 into 60.5, this is also nominal because the effect of inflation is included. However, if I want to predict the cash flow where the inflation effect in my future cash flows will not be given, the price at the end of first, second and third year will be assumed to be same as 0.0, only the effect of increasing quantity will be given, right? Such a cash flow based on respective quantity and the prices of 0 point are called as nominal cash flows. Everyone in the class requesting your responses. Did you remember any kind of this discussion we made yesterday in the session? Everyone in the class, come on, please be quick because I need to take this base ahead in the lecture today. What do you say? Do you remember? Shrividya, yes. Others in the class, let me check if the students are facing any kind of difficulty to join in. No? No messages particularly from any student? Cool. Fine. Soumya said, Weber said, Gauri, Robin, Miral, Chandana, Athena, others, other life people, come on. There. At least say something so that I realize that you're present in the class. I can at least read your name that, okay, you're here with me. Okay. That is how I would be able to connect to you, right? Great. So, sir, whenever I predict future cash flows in the subject of AFM, I would need to discount the future cash flows, right? And these future cash flows, which I need to discount, I need a discounting rate for it, and the discounting rate, everyone, as we've learned, is always the required rate of return. Then you had learnt, everyone, the required rate of return has three components in it. First, an investor would want to earn a real risk-free rate of return. However, if there is an inflation, investor would want to earn the inflation premium as well. And if there is a risk, investor would also want to earn a risk premium over and above these two rates, right? So the main point that you're trying to now learn is, based on the nature of cash flow, you should have a right discounting rate and appropriate discounting rate. Sir, for example, let me take you to it. For example, everyone in the class, let's say that I have a cash flow, right? And the cash flow has no risk involved. There is a short certainty, there is no risk, there is complete certainty, no risk that, okay, this is the cash flow that I will receive every year for the next 5 years. Plus, while predicting that cash flows, the effect of inflation has not been given yet. I have assumed that cash flows based on today's price, 0 points price, which means neither the effect of inflation is given nor the cash flows have risk, which means if they are real cash flows without the effect of inflation, and if they are risk-free cash flow, obviously the rate of discounting that will be used is a real risk-free rate. So you have to realize that your cash flows and the rate of discounting should be aligned. In your cash flows, if the effect of inflation is not there, then do you agree in your discounting rate the effect of inflation should not be there? It is all logical. If the cash flows do not have any risk in your discounting rate, there should not be any risk premium. Everyone, are you able to connect, please? Similarly, sir, this time you have cash flows which are nominal, which means while making the prediction of those cash flows, the effect of inflation in the economy has been included, but the cash flows are risk-free. There is no risk involved while I receive those cash flows. However, while making the prediction, the effect of inflation is included. Then the rate should also include the effect of inflation, which means the rate will be real risk-free rate plus the inflation premium included in it. Requesting your response. And such a rate is called as nominal risk-free rate. The rate is risk-free but has the effect of inflation, called as nominal. Come on, everyone, requesting your responses. Now next, let's imagine I have invested in a project which has risk. Sir, it has risk. There is uncertainty with respect to cash flows. I might receive it, I might not receive it. But while making an estimate of these future cash flows, everyone in the class, I have not included the effect of inflation in it. In the chapter of advanced capital budgeting decision, you will come across such questions. You will come across such questions where the cash flows has risk involved, right? Which means there is an element of risk with respect to cash flows. However, while making the prediction of cash flows, the effect of inflation not given, in such a case, the discounting rate should be real discounting rate, but including the risk premium, which means real risky rate, which is a combination of 1 and 3, right? And the last one, sir, I have cash flows which has risk. Also in them included the effect of inflation. The discounting rate will be nominal risk rate, which means it will have the effect of all three of them included into it. Are you finding it, everyone in the class, super logical? If your answer is yes, you will have to say something, people. However, if your answer is no, you will have to more importantly say something. What do you all say? Are you finding it logical? Come on, quick, everyone. If your answer is no, literally I'll have to speak up here in the chat box. Come on. Done. So I get a response from Riya, Gauri, Srividya, Meeral, Yash. Okay, Chandana. Others, please. So it's a request to everyone. By chance you are lagging behind in this live lecture, kindly make sure that you quickly drag it to the... So the lecture started at 4, right? So accordingly, you can calculate that what time is it when you're watching the lecture, and accordingly, you will have to miss the portion for how many minutes. Right, AVR, who's this AVR? What's your name? Devanshi, were you there yesterday? I don't think so. Great. So, sir, On the basis of this discussion, I would want to take you back to the original discussion where we learnt the discounting. So do you know, if I have by chance the nominal cash flow, or if I have the real cash flow, how can I find out nominal? Or if I have the nominal cash flow, how can I find out real? Sir, it is all easy. It is extremely easy in the sense that I just have to give the effect of inflation, which means suppose, sir, at the end of second year, my real cash flow, for example, is at the end of second year or at the end of third year, my real cash flow is this, sir, which is 120. Everyone in the class, 120 into 50, which is 6,000. Right? I want to find out how much should my nominal cash flow be, which means, do you agree, in this cash flow, which is the cash flow of second year, I need to give the effect, sorry, which is the cash flow of third year, listen to me, I need to give the effect of inflation for 3 years in this cash flow. Please realize, how do I give the effect of inflation? By 1 plus rate of inflation to the power 3. Sir, why to the power 3? Because even inflation works on a compounded basis. If first year's price was 0, second was 50 plus 10%. Second year was 55 plus 10%. Third year was 60 plus 10%, which means with the compounding effect, which is why 1 plus rate of inflation to the power 3. Everyone, so 6,000 is the real cash flow of third year. Can you please find out the nominal cash flow of third year? 1.1 into equals to multiplied by 6,000 will give me 7986. 7986 as the nominal cash flow of third year. Someone please confirm that if 120 multiplied by this nominal price, 120 multiplied by 66.55 is 7986 only, the answer is yes. That is how you convert the real cash flow to nominal. Sir, similarly, if I have been given the nominal cash flow, can I find out real? The obvious answer is yes. To the nominal cash flow, you divide by 1 plus I to the power n, and that is how you do the real cash flow. Please observe that. Please observe. Do you agree that you are discounting and compounding in this case, people? Do you people agree that you are calculating the future value of it by multiplying 1 plus I to the power 3? Everyone? Come on, come on, come on. Do you agree that we are calculating a future value of an amount? The answer is super big no. The answer is super big no. The cash flow is already standing at the end of third year. And by multiplying it, inflation rate, it doesn't go anywhere else. It continue to remain in third year, just that it from real it become nominal. It is not the interest rate to do compound discount or do PVFV. It is the inflation rate to convert from real nominal or nominal real. Am I strictly clear on this? If this was something new for you to learn, you'll have to this time press like. Everyone on the video. Are you understanding? And please observe the formula. When I write here n, 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 it has got a relationship. Means that if this is 3 real, then I'll have to compound it 3 times to get the nominal of 3. That is what the point here is. Sir, next one. Sir, similarly, let's imagine that you told me if the cash flow is nominal, even the rate should be nominal. If the cash flow is real, the rate should be real. So is there a way to convert a nominal rate of discounting to real rate of discounting? The answer is yes. Right? The effect between them is not additive, it is multiplicative, in the sense that, let's say that my real rate is 8%, my nominal rate is 3%, right? That does not mean that my real rate is 8%, my inflation premium is 3%, that does not mean the real rate is, no, nominal rate is 11%. No, real plus inflation, that is not how the nominal is. The relationship on the other hand, everyone, is additive, multiplicative, in the sense, sir, 1 plus 8% multiplied by 1 plus 3% is actually 1 plus whatever is the nominal rate. So if you have to calculate to multiply this into this, and whatever is the answer, from that you have to deduct this one, and that is how you get a nominal rate. People, the relationship is multiplicative. There is this example here. We don't feel a need to discuss this in the class because we'll have a lot of questions where we do this thing. All right. I just need your quick response. How much are you settled on this, everyone? Please. Quick. An ultra quick validation of how much are you settled on this. People, what do you say? Quick. Can I take you ahead? Because now we need to, with this discussion, get started with the first chapter, first practical question based chapter, equity and business valuation. People, such a brilliant chapter, equity and business valuation. For your comfort, again, let me take you to the index and tell you where in the index or where in the institute's study material it is. Sir, in the chapter of security valuation, you have this part called as equity valuation. Okay, and business valuation is 13th chapter of institute's study material, and that is how you get the chapter of equity and business valuation will cover in one go. Right? Cool. Now, sir, starting with the chapter of equity and business valuation, I don't know which page of your book it would be. Let me check it. So I want you all to come to page number 9 of your OutNotes. Page number 9 of your OutNotes. Because other basic things I will tell you with time, not necessarily everything now. Okay, come on. Sir, the objective of this chapter is to be able to find out the value of equity share, or if not equity share, the entire company as a whole. To find out the value under this in your syllabus, there are multiple ways to do it. First way is that on the basis of dividend that company distributes, we'll have to find a value. Then on the basis of cash flows that company generates, I'll have to find a value. Then on the basis of assets that a company has, I will, on the basis of earnings it generate, I'll have to find a value, and the last one is relative valuation. Primarily these 5 ways to find out the value of a company. Other than these, I have certain topics to be handled. They are equally important to be handled at the end, right? Starting with the first model, which is dividend based valuation model. People in the class, again, I would say you'll have to forget and unlearn the things that you've already learned. Else you are going to literally struggle in the thought process. If you have trusted me with this batch, you will have to trust it entirely. You will have to unlearn everything. And I am committing that I will make sure that you relearn with your best quality again everything in the class itself. People, getting started with dividend valuation model. You know what? Whether it is dividend based discounting or cash flow based discounting, or even if it is the chapter of fixed income securities, for all three of them, there is a common thought process that you need, and the thought process everyone in the class is fundamental principle of valuation. Let me say this line, let me explain this principle really well. Listen to it very carefully. The principle says that if I want to find out the value of an asset today, people, at this point today, the value of asset will be whatever future cash flows are generated from this asset. Cash flow first year, second, third year, whatever cash flows are generated over the years, present value of all those cash flows is the value of asset at point 0, which means the equation, the thought process of valuation become the value at this point is nothing simply but present value of whatever cash flows that asset will generate. Such a simple concept, right? For example, sir, if I want to buy an equity share, which is an asset, what will be the value of equity share? Present value of dividends, because when you hold equity share, what all would you receive from an equity share? So dividends till you hold it, and whenever you want to sell it, the selling price, hence the dividend plus selling price are the future cash flows, doing PV of it will be the value of equity share. Similarly, when you hold a bond, present value of whatever coupons you will receive and the redemption value will be the value of the bond, and any other asset, the same rule applies. All right, great. Sir, which means we can have two possibilities with us in the exam. First, the number of years, the years given, my holding period given in the exam, right, in the practical questions may be finite, which means a fixed period, for example, of 5 years or 10 years. So the cash flows basically will be dividend of respective number of years. Like if I hold the bond, hold the share for 5 years, right? Please imagine the things on my timeline. I will receive the dividends for the next 5 years, and at the end of 5th year, I will receive the selling price. So basically, I will have to discount all these cash flows at a rate which is suitable. We'll talk about rate and everything, right? But that is how I will calculate the value. But that is a situation when I know that I'm going to sell the share at this point, which is not even 5% of the question. 95% of the question belong to a situation where I hold a share for indefinite number of years, which means I don't know till which point will I hold it. I continue to assume it till infinity. People, which means the dividend which I receive every year are assumed to be received till infinity, and we need to discount all those dividend till infinity to find out the value of share at point 0. I just need your everyone in the class. I literally need your response. Are you people able to connect to whatever has been spoken? I would try to speak everything only once. Come on. Are you able to imagine the things with me, Srividya? Alright. Others in the class, I'm literally looking for your yes. Desperately. Chandana, yes. Others, please. Others. Gauri. Which means we need to understand that, okay, these are the two ways I'll have to handle a situation. Answer from Yash is yes, Soumya is yes, Shravan is yes, Deepak is yes, Robin is yes. Usha Rani, all right, good evening. Ria is yes. What is this Jan? Jan, what kind of name it is? Is it your actual name? Peep. Jan. Purshi, yes. Other live people, are you able to connect and record it whenever you guys watch it? Please. Done. Great. So, sir, discounting this scenario is still easy because I know the real cash flows and I have learnt the discounting rules and the basics, right? I can simply create a table, multiply these cash flows with the present value factors, and okay, I can multiply the present value factors to respective cash flows and find out the PV. We will do it. But the question is, if the dividend goes till infinity, can I manually discount the cash flows? Everyone, give it a thought. Can I manually discount the cash flows if I have the cash flows going till infinity? The answer is no, which is why in this situation you will have to use dividend discount models, right? So basically, please listen to me. The value of a share at which the value of a share that you calculate at point 0 is called as intrinsic value. Please understand there is a difference. For example, we talk about the share of TCS. The price of share of TCS is already there in the market. That is called as CMP, the price which is actually there. But the one that you calculate is the price which should be there. There is a difference between CMP and intrinsic value. The price which is there is CMP. The price what should be there, what is the real or the true worth of a share, that is its intrinsic value, called as equilibrium value and fair value. So we will calculate every time the intrinsic value. But you have to please think practically, which means imagine that if intrinsic value by chance is equals to CMP, price of the share in the market is 400, and as per our calculation as well, it should be 400. Which means, can I say a security is fairly valued in the market? The price of the share in the market is what it should be. In such a case, examiner, everyone in the class, would use the word examiner generally assumes the security to be fairly valued, and which is why it will interchangeably use the word intrinsic value and CMP. You should know the difference. At the same time, you should have a clarity on the assumption by examiner, and that is how he will use the word interchangeably. Practically, you cannot find out CMP, it's there in the market. You can just go to the market and see it. You can't calculate. But how would you calculate? On the basis of this assumption that the two are equal. Come on, everyone, please. Please. The next question that comes to your mind, that should come to your mind, is that, sir, if we discount the cash flow, what will be, people in the class, the discounting rate? Because do you agree the discounting rate is the required rate of return? So how much required rate of return an investor would want to earn on these cash flows? Sir, the required rate of return depends on the risk involved. Can you people tell me which formula of required rate of return involves in it the risk that equity bears? People, people in the class, come on. Very difficult question, I think. Was it? Which required rate of return, in your knowledge, has an effect of or includes into it, right, the effect of risk that equity has to bear? People in the class, the formula of CAPM, which is RF plus beta into RM minus RF, something which is so much there in your blood, right? I mean, this is so much in your blood that I don't even need to teach this to you, right? Which means, do you realize in this entire formula, I mean, let me take you for a second to something ahead of it. How many of you, I'm saying something, if you are able to relate to it, it's fine. If you are able to not relate to it, ignore it. You're not missing out on anything. But do you people agree beta, when you go to portfolio management, I'll teach you again, the beta in the portfolio management as we read is nothing but the risk of a security, specifically saying systematic risk. So do you agree beta gives the effect of risk involved, and which is why accordingly you get the required rate of return using the formula of KE? Yes, people in the class. So in this entire equation, I can calculate the KE, and people, RM minus RF, this particular called as market risk premium, right? And beta into RM minus RF, this particular part is called as security risk premium, right? RM minus RF is common to all the securities, right? Whether it is security A or security B, because do you agree RM is return from market, RF is a risk-free security, and these two things do not belong to any particular security, they are common for all. But beta for different securities are different, hence market risk premium is common for everyone, and the security risk premium is specific to specific securities due to specific beta. Come on, come on. Are you able to, people in the class, listen to me that badly? Shall we? Shall we proceed? So, sir, that is just one way to calculate the cost of equity. The required rate of return for equity shareholder is called as what? Cost of equity, in short KE, and KE has first preference to be calculated as this. Another way to calculate KE is using the Gordon's formula. Gordon's formula, this formula you must have seen somewhere. Sir, D1 divided by P0 plus G, this is the formula. Sir, where does this formula come from? Have you seen D1 divided by K minus G is equals to P0, right? The Gordon's formula. To this formula, when you shuffle and rearrange such that everything comes opposite to K, the formula become K is equals to D1 divided by P0 plus G. Your first preference of calculating K in the entire AFM should be this. If the data of RM, RF, etc. is missing, go for this formula, which is D1 divided by P0 plus G. However, if even this is not sufficient, this is not given, the third and the last preference is earnings yield. In the session yesterday, I told you that whenever examiner asks you for the word yield, everyone in the class, whenever examiner asks to you for the word yield, do you remember I said it is a kind of return based on, in the chat box I need, it is a return, always a return based on market price. And when it is earnings yield, which means it is a return on based, return which considers earning. So the formula of return has always been very simple. In the denominator, it is the amount you invest, and in the numerator, you return the return you make, right? So by investing MPS, which is a market price based return, how much did you earn? EPS. So EPS divided by MPS become the formula of KE as per the last preference, which is earnings yield formula. But sir, I remember a similar formula I read yesterday of P ratio, which was MPS divided by EPS. Oh my God. Did you realize one is the inverse of another? People, EPS divided by MPS and MPS divided by EPS. Everyone, which means can I say KE can also be considered as opposite of inverse of P ratio, which is 1 divided by P ratio as your last preference. Are you people clear with the three ways of calculating KE? Done. If yes, I'm going to immediately take you to the next one, which is this particular part we will handle later on. This particular part we will handle later on. We need to go to the first category of dividend discount model. These dividend discount models have three categories. To be frank, four, but primarily three, right? First category is zero growth model, another is constant growth model, and the third one everyone in the class is variable growth model, right? Let us be really quick. Let us be really quick, people. So zero growth model, you have to assume, you have to imagine the dividends. Do you know the ultimate rule? How many of you remember that ultimate rule? The core principle is that present value of future dividends is the value of share. Future dividends till which point? Till infinity. Present value of future dividends till infinity. Present value of that is the value of share. Sir, I had to create different models because the dividends are given in a different manner. Possibility one, sir, all my dividends are constant till infinity. There is no growth in them. Same amount of 5 rupee dividend to be received till infinity. The way to calculate present value of them will be different. Let's imagine another scenario where the dividend for first year is 5. But every year the dividend will grow by 10%, so it becomes 5.5. Then 5.5 plus 10%, it is 6.05 plus 10%. Sir, it is 6.665. So this way, if my dividends grow constantly at a constant rate of 10% till infinity, such a case is called as constant growth in dividend, right? So depending upon the pattern of dividend, your model gets decided, right? Where the first model, let me introduce a zero growth model. Please try to recollect the concepts of time value of money you've read here. The concepts of time value of money you've read here, people tell me if I receive a constant dividend of 5 forever, which are to be discounted at the rate called as KE, how would you calculate the present value? If I don't teach you, give me the answer. For this, I'm not going to teach you. You need to give me the answer. What is the present value of a perpetuity if you realize? Do you realize 5 rupee forever? Everyone is perpetuity. Till infinity, same amount is perpetuity, and present value of perpetuity was A divided by R. A divided by R. What is A in our case? The amount of annuity, which is dividend divided by R in our case is KE. So dividend D divided by KE becomes the formula officially you need to understand. D divided by KE. Sir, what will this give you? Either you call it P0, price 0, or intrinsic value 0. Yes, that is not 1.05, that is just 0.05. So assuming the K is 5, if the assume is K is 10%, it is 0.10 simply. Everyone, this is something basic you would already know. But you know what is something which will add to your existing knowledge is what I speak now. Everyone in the class, you have to realize that what you use in this formula is the D1 and not D0. 1 second. What is D1, D0? 1 second. So for example, you receive 5 rupee dividend at 0.0 is D0, and D1 is the dividend that you receive at the end of first year, which is again 5. Sir, what are you saying? How does it matter if the dividend is of 0 point or if the dividend is at the end of first year? Both of them are 5. Agreed. But you should in your brains have complete clarity, especially in our class. The conceptual clarity cannot be compromised. You should have the complete clarity in your brains that the first dividend which is discounted is not D0. If you stand at 0.0, if this is where you stand, the first cash flow you will receive is the cash flow of year 1, and the discounting starts from year 1 and onwards, not 0.0. Am I strictly clear, everyone in the class, please? So I will say D1 divided by K will give you P0. Come on, yes, no, quick. Can I take you to the next one, please? The next one, everyone in the class, is constant growth model, also called as Gordon's model, to be applied. To be applied when the dividend grows constantly at a fixed rate till infinity, right? Okay. In which case, the derivation obviously we cannot discuss in this small 60, 70 hour batch, right? But d1 divided by, people in the class, d1 divided by k minus g, this formula is going to give me the value of share at 0 point. But sir, one second, you are misleading us. Once you told me that the value of a share is the present value of future cash flows, and now you suddenly bring to us this particular formula. What is this formula doing? People, please understand. Let's say this is D0. D1, sorry, this is D1. So D2 will be slightly bigger, D3 will be slightly bigger, D4 will be slightly bigger, and that's how infinity. So all these cash flows are to be discounted at point 0 to calculate the intrinsic value or price at 0 point, everyone. Through this formula, you are discounting them, everyone, where your dividend of first year is D1, your discounting rate is K, right? And the rate at which dividends are growing, the growth rate, that fixed growth rate of the dividend is G. Come on. How much out of 10 are you able to process everything which has been spoken in the class so far? Everyone, please. Everyone, please. Come on, come on, come on, come on, everyone. Woho! Devanshi is here. Yash, Gauri. People in the class, just a thing. Are you able to process the language? As in, am I able to speak English correctly? Is my question to you. Venkat is here. Yash is here. Chandana is here. So, is Venkat a common name in southern India? Is it so, people? Venkat? Because in my CFA batches there are a lot of students from southern India, and in every batch I remember there is a student always named as Venkat. So probably you people would be knowing the scenario over there in your region. Is it a common name out there? That's based on Lord Venkateshwar. Okay, because particularly this name I remember in all my CFA batches, right? And even in this AFM batches there's always a student named as Venkat. Okay, cool. So great. People, now let me take you ahead to the clarities of this concept. Sir, you should observe certain points. You should observe certain points. Point number one. In this formula, which is the first dividend which I discount, when you say present value of future cash flows, which is your first future cash flow, it is the dividend of 0 year or 1 year. The dividend of first year is my first future cash flow. When you discount the dividend of first year and onward years, the value that you get back, the value which is being calculated is not at the end of first year, the value is at the end of 0 year, right? Next. Sir, discounting rate K is fine, that you know. My next question is the growth rate. Do you agree that is the constant growth rate till infinity, which means the growth rate right from point 0? Suppose I stand at point 0. So I need a constant growth rate right from point 0 to infinity or something else. People, when I say growth rate is the constant growth rate till infinity, that is the growth rate of what? Growth rate of revenue, growth rate of dividend, or growth rate of earnings? First question. And that too from year 0 to infinity or something else? People in the class. People in the class. Come on, come on, come on, come on. In our class, we don't discuss just the formula, but the flow as well. Come on. All the life student, I won't proceed unless you give me the answer. Growth from which year to which year is my question. Growth till infinity is fine. Everyone knows the end point. I'm asking to you the start point. Dividend growth rate, the start point will be 0 year or some other year, everyone. Sir, but we never thought so. Everyone, the growth rate I need, please, the growth rate which I need for it to be consistent or constant is from year 1 to infinity. From year 1 to infinity, you should have a constant growth rate, which means, are you people saying that even if you have a different growth rate from 0 to 1, it will work? I can apply Gordon. Come on, come on. Those who say, listen to this situation. Suppose you stand at point 0, right? The dividend at point 0 was rupees 10, right? Suppose the dividend of first year grows by 20% and it become 12, right? And after that the dividend grows by 10% every year till infinity. Same 10% till infinity. Do you people mean to say that I can apply Gordon's model at point 0 despite it has a different growth rate once and then same forever? What do you say? Quick. Can I apply Gordon's model in this case where the growth rate of first year is different and all other years is different? Please. If you think no, the answer is incorrect. If you think yes, the answer is correct. Even if for the first year the growth rate is different from the growth year which is then consistent till infinity, I can consider to apply Gordon's here and I will get the correct answer. Hence, everyone in the class, if still was a, so I will, everyone in the class, take you through this situation. Not now, but I will take you through the situation later on. You don't have to specifically worry about it. That's sir how. When I go ahead, I'll take you through it. When we go to variable growth model, and sir, Gordon's can be applied even in such a situation. All right, cool, done. So sir, let me try to tell you the beauty of OutNotes. See, if I want to teach you certain things, right, which are important, which will help you evolve, people, do you agree that I can't make you people write down everything? But if certain things are already written down, I can take you through them. For example, sir, D1 is used in the formula and not D0, first thing. Second, the value is arrived is P0 and not P1. Third, the growth which has to be constant is the growth in dividends, first thing. Growth in dividends from year 1 to infinity. I'm concerned about the growth, but growth of revenue? No. Growth of earnings? No. I'm concerned about the growth of dividend. So from year 1 to infinity, the growth should be constant, and from 0 to 1, it can be different, and the last and the best. People in the class, I need your attention. Everyone. Sir, is the growth in earnings and growth in dividend same? Are the two things. First is growth in earnings and the second is growth in dividend. Are they the same? People? Or they can be different? What do you think? So there's this student called as CA Journey who's asking is it fine if I buy the lecture now? All these people, for your information, have just bought the lectures in the last 2-3 days. Okay, it can be different, and if it can be different, how does it depend if it is the same or different? Let me explain to you with all my clarity. People, let's say that my EPS is rupees 100 at point 0, right? And the payout ratio is 50%. Payout ratio, do you remember what percentage of my earnings are distributed? So it turns out to be rupees 50. Suppose my earnings grow by 10% in the next year. At the end of first year when I stand, EPS from 100 it increases to 110. And at the end of first year, again my payout ratio is 15%, 50%, which means of 110, I will end up distributing as dividend 50%, which is rupees 55. Can you please tell me at what rate has the DPS grown? When the EPS grows by 10, DPS also grow by 10. Cool. Now, one more year. Suppose when I go to second year, the EPS grows by 20%. So 110 on calculator plus 20% is 132 as the amount of EPS. But you know what happens? In the end of second year, my company changed the dividend policy and decide to distribute 60% dividend. People. So of 110 where I was distributing 50%, it was 55. Now of 132, if I distribute 60%, 132 multiplied by 60% is 79 by 2. Everyone on my calculator, use your calculator to calculate the growth rate in this case of dividend. Use your calculator to calculate the growth rate, everyone in the class in this case. Come on. How much is it turning out to be? 79.2 minus 55 divided by 55 tells me 44% growth rate from year 1 to 2 as the growth rate of dividend. But sir, the growth, everyone in the class, the growth in EPS was 20. How the DPS growing by 44? Because everyone, please realize, of this amount, 50% got distributed. My EPS grew by 20% is fine. But on that grown amount of 20%, on this grown amount of 132, this time I am distributing not 50 but 60%. Of a bigger value, I want to distribute a bigger percentage, obviously will lead to a higher growth rate. In such a case, a different growth rate. In conclusion, can I say, now I'm trying to put in a conclusion, right? I'm trying to put in a conclusion, everyone. Sir, growth rate is always between 2 years, from year 1 to 2 or 2 to 3, right? So for those 2 years between which the growth rate I'm talking about, if the payout ratio between these 2 years is same, then growth in EPS is same as growth in DPS. Can be considered same for the growth of DPS. However, the period for which I'm talking about, in that period, if the payout ratio is changing, the opening payout ratio is something else, whereas the closing payout ratio is something else, then the EPS growth rate, people, cannot be taken same as DPS growth rate. Everyone in the class, could I very clearly convey in my words the concept of this? What do you all say? Come on. Am I able to deliver to you the needed amount of clarity, people, please? And if your answer is yes, again you need to hit the like button. But wait, if already hit it, you will end up unliking it. So only those who have not liked the video yet, you will need to, everyone in the class, like it now. Only if you think that it has added to your knowledge. Okay? Great. So it will be my test today. So let's play this game. You'll have to hit the like button only if you feel that by attending this lecture particularly, it has added to your knowledge. If the answer is no, then don't hit the like button. Done? Cool? So, okay. At least I would try to find a point which adds to your knowledge. Obviously, which is relevant for an exam, not the knowledge in general. Cool. Sir, so okay, this is the clarity, which means you know what? If institute, everyone in the class, if institute does not say anything, listen to the words I'm saying. It's very important. If institute does not say anything about the payout ratio, we assume it to be the same every year. And if we assume it to be the same every year, the earnings growth and the dividend growth continue to remain the same. What do I ultimately need? What do I need is the growth of dividend. What do I ultimately need? What is G in my formula? Sir, G in my formula is called as sustainable growth rate of dividends, not of earnings. Growth rate of dividends I need, right? So I can assume the growth in earnings given in the question to be same as growth of dividend. However, the level of clarity is required when the examiner give you growth of earning. But also give you the effect of change in payout ratio, and from that you need to calculate the growth of dividend. People, everyone in the class, are you able to process whatever is being spoken? So we will have to read the words of the examiner really carefully and figure out what has he given to us. Growth of earnings or dividend. If earnings, we need to find out dividend. If it is constant, the payout ratio, I can assume it to be the same for dividend. Done. This is first level clarity with respect to growth, with respect to dividend, with respect to KE, and with respect to IV and IV0 and PP0 for this formula. Yes. Now the next one, everyone in the class, sir, KE calculation, you are all clear? The detailings you are all clear? D1 and D0, if there is a confusion, please look at this note, right? The examiner says company distributed a dividend, it is D0. Company is expected to distribute a dividend, D1. Company will pay the dividend, D1. Company has paid the dividend, D0. But if the examiner says company pays a dividend, what do we consider it? In generalized statement, it is neither it's with respect to past nor future. In such a scenario, you should consider it to be D1, everyone in the class, is what I'm saying. Sir, is that a rule by institute? Answer is no. I tried to observe the question by the institute and I realized that in 60 to 70% of them, or maybe even in 80% of them, institute considers D1 and not D0, which means we might find rare circumstances, but there is no better way to remember it than the fact that, okay, we need to consider D1. Shall we, with all that, requesting your responses, proceed to the questions now? Come on. Because now you need to have your calcs open with you. There with you, I mean to say. Shall we? Great. एग्जाम में सेम आया, D1 लिए उसको रॉन्ग कर दिया. यश, that is a different question. I will tell you what is the problem with that question. We have the same question and OutScanner will come across it. In that case, if you realize there was not even an assumption needed, examiner said it is an anticipated dividend. It was supposed to be D1 if you realize. That's not your mistake. Okay. Well, what do you say, everyone? Can we proceed? Do we have people in the class? The energy is to get started. Shall we? Come on. Yash is here, Gauri is here. Come on, others, people, we are not supposed to sleep here. Come on. Wake up and get started, people. First question is so easy that it is going to be a homework question. Question number 2, right away in the class, people. Question number 2, right away in the class. A company has a book value of 137.8. All right, book value per share is given. Return on equity is 15%. Oh my God, how the two things are related? Can you people go back to the concepts notes and try to recollect the relationship between ROE and book value per share? One second. Sir, ROE is the return based on book value that I remember, which means on my book value, how much return am I able to make? So ROE is how much EPS I'm able to make on my book value per share. So if I have a book value and if I have ROE, would I be able to calculate EPS? The answer is yes. Okay, hold on. It follows a policy of retaining 60%. 1 second. Once I have EPS, I know a part of it will be retained earning and a part of it will be dividend. 60% will be retained earning and the 40% will be dividend. Okay. If the opportunity cost of capital, everyone, this is nothing but KE. Also called as opportunity cost of capital, discounting rate, required rate of return, KE. Sir, if the KE is 18%, what is the price per share? Sir, which model? Zero growth, constant growth. Which model do you think will apply? Then I will decide the answer. Sir, the examiner, if does not say there is any growth, we will apply zero growth model. But first of all, you need to think, is there a way to calculate the growth? The answer is yes. I am yet to teach to you that thing. I am yet to teach to you that thing in question number 2, but we'll have to apply the constant growth model, which means what I need is D1 and K and G. Using this formula, I can calculate the things. Right? Sir, do you have the amount of D1? It can be calculated. People, if book value is 137.8, can I multiply the book value per share with the ROE to find out the EPS? Everyone? So book value is 137.8. Common sense, of this value, how much return do you generate? Of that 15%, so 20.67 EPS. Of which, how much is your dividend? Sir, 40%. Of this, 40% is 55. One second. 20.67 into 40% is 8.268. People in the class is the amount of dividend. People in the class is the amount of dividend. Sir, whether we should consider it D0 or D1, as I said, if the question is silent, always D1, 8.268. Sir, the number of K of 18% is already given to you. Now the concept of growth. People in the class, such a easy formula. The concept says, people, that growth is calculated as retention ratio into ROE. How many of you already know this formula? How many of you have already read it at some point in your life, that growth is retention ratio into ROE? Come on, people in the class, quick, yes or no in the chat box. All live concurrent viewers, I have 32 at this point right now. I need a response, everyone. People, people, come on, you've read it somewhere. In this case, can you tell me how much is the amount of growth of dividend? In this case, can you people tell me how much is the amount of growth of dividend? Sir, sir, it is my ROE of 15% into 60% of it. So 15 into 60% is equals to 9% is the rate of growth. My question to you all is, this formula gives to you what? The rate of growth of dividend or the rate of growth of earnings? People, let me add to your clarity, such minuteness is generally being. Now you're guessing it correctly. But please admit, please try to admit. I know you're guessing it correctly, plus please give me a fair response. How many of you before this lecture already knew that it is surely the growth of earnings? I mean, most of the students never give it a thought because they are not made to give a thought on it. People in the class, this formula tells you the growth of earnings. You are answering it correctly. If you knew it, it is appreciable. Ria, you attended the lecture before this. Come on. This is my own puppet only. So let me tell you, this formula gives to you the growth of earnings. Sir, generally it is being taught to students, how do you calculate sustainable growth rate of dividends? Its students are being taught retention ratio into ROE is the growth of dividend. No, my bro, it is the growth of earnings. However, if you assume the payout ratio to be same every year, then you can assume it to be the growth of dividend as well. That is how the entire linkage is. Are my clarities able to touch to you? People. So to the examiner, you don't need to explain everything. To the examiner, you don't need to explain everything, but you should always know it so that you don't commit a mistake. Sir, I will say my growth is 9% of dividend. Since there is no point specifying the payout ratio change anywhere, I will assume it to be the same for dividend, and I have the growth rate of 9%. And my answer will be 8.268 of dividend D1 divided by 0.18 minus 0.09. 0.18, 0.18 minus 0.009, 8.268, give me the answer. 8.268 divided by 0.09, net 91.87 on a rounded off basis? Come on, please. Come on. Do you have the answer? In the first question itself, I would want to teach you one more thing entirely applicable. I mean applicable for the entire AFM. But I do that only after people in the class. You give me a thumbs up in the chat box that you are clear with 91.87. Come on, people, please. Come on, people, please. What do you say? I mean, if it is difficult to say thumbs up in the chat box, you can also say yes. I mean, it's, I think, more difficult too. Miral, Chandan, Jan. Jan, come on, please change your name to Jahan. Okay. Gauri, done. Yes, Usha Rani. Venkat, Robin, Shravan, Divanshi, Pulshi, Srividya. What is happening? Other live people, come on. Done. Cool. Sir, what is the rule with respect to rounding off? So you have to, people in the class, all these amounts like EPS, like DPS, like the price of share, like all these amounts are to be rounded off till 2 decimal points. You don't have to write it down. I'll give you a summarization of it. Don't worry. All these cash flows you need to round off till 2 decimal points. But before you round it off, you have to first realize when do you need to round off. Which means suppose I make a calculation where the EPS is turning out to be 5 to 5. So point is, if something is naturally only till 3 decimal point or 4 decimal point, don't think of rounding it off. Round off only when there is a need, in the sense that answer is 5.52863984 something something something. If something is naturally till 3 or 4 decimal points, don't round it off. Am I clear, everyone, please? Come on, quick. Which is why if you realize I did not round off this dividend to 8.27. This, whether you find this done anywhere in the OutScanner or not, you need to continue to follow this rule, everyone. Something for it to be rounded off first should have a position of being round off, right? Something is naturally till 3 or 4 decimal points, don't round it off. If it is extended, then think to round it off till 2 decimal points. Had the EPS been 7964 something something, we could have rounded off till 2 decimal points in this case, the DPS amount, sorry. But we won't, because it is naturally till 3. Done are we? Done are we? Set. Sir, question number second gets done. Question number third, extremely easy question, will have to be done at home, and that too only on Calci. People, when I say only on Calci, please now listen to something really well. You are giving 2 hours every day in the class. Along with that, what are you supposed to do at home? Listen to me very carefully. Whatever has been taught every day, the concepts you are supposed to revise, because otherwise next day you won't be able to process. The lectures you might feel, sir, are so extended, but you have to feel that it is just for 5 days a week, and that too for 2 hours every day. Right? Which means every day along with your AFM lectures, SFM lecture, you would be able to very easily plan 1 or 2 more subjects. First thing, right? Sir, every day you are supposed to revise the concept. Won't take more than 15 minutes if you are paying 100% attention in the class, right? And every day, whichever questions are solved in the class on the calculator, you are supposed to solve them, all of them, classwork and homework, all of them, again in at home in your notebook. It is only when you do this, let me tell you, with this a small batch of 60 to 70 hours, you can gain the marks of 60 to 70 plus manageably. People, It is executable. It is possible to score 60 and 70 plus at this point where you stand. People, at this point where you stand, you would be able to gain 60 and 70 was provided you follow the instructions given in the class. Am I strictly clear on this? This is not a fake motivation I want to give to you, but a practical guidance I want to offer. Acha, give me one thing, people. At this point where you stand, how many of you think it is possible to score exemption in AFM? Come on, come on. How many of you think you are capable and you think you would be able to score exemption? You can do it. Come on, give me an answer. Come on, come on, come on, give me. If the answer is no, have the courage to say no. If the answer is yes, have the courage to say yes. I'm not asking whether you will or not. I'm asking, do you think you can? Yes. Because do you know one thing? If you don't believe now, you would surely be not able to do it. People, you would be able to do it only if you first of all think that I will be able to do it. For you to do it, first you should have a mindset that I can do it. And let me clearly tell you, given the time we have, it is 100% manageable to score exemption at this point where you stand if you start to prepare now. Okay, and for that, let me tell you things right from the scratch. Sir, the concepts notes and the question bank you have, they are all detailed, they are all complete, comprehensive, super sufficient. First thing. Second thing is the learning you're having in the class, that is all organized, systematic, again very detailed, logical. I will try to make sure you have a lot to understand and a very less to remember, right? And third thing, everyone in the class, the most important part, every day at home, if you are able to put in additional efforts, that you will have to, else don't expect that 70 plus kind of score, right? If you can put that, you will have to additional 1 hour or whatever number of hours needed to make sure that you do two things. One, revising the concept and writing the question down in the notebook, because if you don't do so, don't expect more than even 50 marks in the exam. And in fact, better you claim refund in such a situation. I don't want any such student who is solving the things only on the calculator and ultimately not able to succeed in the exam. Better you WhatsApp me that, sir, I'm not doing it, kindly give me refund. I'll be happy to do so. But please don't make this mistake if you really want to pass. So are you, everyone in the class, making this commitment, not to me, but to yourself, to be consistent every day till we have the lectures? Everyone. Every day when you watch the lecture, you have this commitment. Do you have it with yourself? People, please. Come on. Are you making this commitment not to me, obviously, but to yourself, and not the commitment of marks? Come on. I'm not even asking you to commit me 60 plus. I'm asking you to commit me your efforts every day. That you can do. That is in your hand, surely. Yes? So that's a fixed thing. I don't have to motivate you every day to do it. We are now every day with this mindset, put in the effort, and let me tell you, when you do it, at the end of the batch, you will say, sir, now I'm prepared for AFM. The needed level of clarity I have, and that will bring to you the needed level of confidence. That's my assurance. Okay, so great. Now fine. First question in the notebook you will do, we have done it in the class. So flow will be green color is classwork, red color is homework. If I don't mark anything, which means you don't need to do that question, right? Because we would need to maintain the exam orientedness, right? When I write only on calci, you need to do it only on the calci, no need to do it in the notebook. Done? So first question, homework. Second question we have done. Third question only on calci, homework. Fourth question, we can consider doing it in the class, which is extremely easy. Come on. Super easy. Come on. Sir, following are the details for X and Y 2 shares. All right. Dividend per share is 4.4. What did you consider? D1, D0, D1. Sir, growth rate is 10.10. All right. The beta is 0.9, 1.2. The current market price is 150 and 70. Sir, risk-free rate 7, RM 14. Calculate the price for share for both the companies. Let us do it for X right now in the class. Let's do it X. Sir, for price per share, do you agree if you have a growth rate, it is Gordon's model? So D1 divided by K minus G is what I need. What all do I have? Sir, do I have D1? The answer is yes. Do I have the growth rate? The answer is yes. Do I have the K? Sir, CAPM I can apply. So RF is 7 plus. What is the beta? 0.9. Wait. 7 plus 0.9 into RM minus RF, which is 14 minus 7. What is the number of K? What is the number of K? Sir, 14 minus 7 into 0.9 plus 7 is 13.3. People in the class is your K. So you have 0.133 minus 0.10. 4 divided by this number will be the value of share. So 0.133 minus 0.1 divide equals to into 4 is equals to 121.21. Waiting for the answers from your end, everyone in the class. Come on. Are you people comfortable with whatever is going on? Please, please, please. Did you get the answer of 121.21? Which is absolutely a correct answer. Sir, without solving, can you tell me for share Y? The price will be higher or lower without solving it. Only just by looking at this table can you guess the price of share Y will be lower than X or higher than X. Come on. Let me test your analytical skills as well. Let me check how analytically are you able to process. Because with this batch, I would really want you to evolve, not just solve the question. Usha Rani thinks it will be lower. Come on everyone, come on. Only on the basis of this table. Meeral thinks lower, Robin thinks lower. If everything will give me a correct answer, then I will degrade the level of question. I'll have to unnecessarily say that it was an easy question. So obviously it was an easy question. Everyone. Sir, higher beta will lead to a higher KE. Right? Because otherwise everything else is same. And do you realize when the discounting rate is bigger, the present value is always lower? In fact, do you realize in the formula of D1 divided by K minus G, if K increases, the overall denominator increases, leading to a lower present value? Come on everyone. Are we settled on question number 4? So first part we have done. Second comment on the valuation. Sir, the value according to us is 121. The price in the market is 150. Sir, can I say 121? Since it is lower, the share is undervalued. 121 that we calculated, everyone in the class, on the basis of it, can we say the share is undervalued? What do you think? Quick, yes or no? Can we say the share is undervalued? The answer I need in the chat box. The answer is big no. Because you never, everyone in the class, you never comment on the price which you calculate, rather you always comment on the price which is there in the market. Right? So you have to comment on the valuation of the share by comparing it with its market price, and you will say, since the price in the market is more, everyone, then the intrinsic value which we have calculated, and which is why we will say the share is overvalued. Requesting your responses. Did you understand what are you supposed to comment on? The market price, the actual market price. Hold on. And which is why if you see this table, this is what this table of pricing is. If CMP is more than intrinsic value, overvalued, CMP is less than intrinsic value, it is undervalued. And if CMP is equal to intrinsic value, it is called as fairly valued. And you should, everyone in the class, know if something is overvalued, if the market has a price which is more than how much should be the price, it is overvalued and you, one second, action is sell. I think I write opposite of it. If something is overvalued, you sell it. If something is undervalued, you buy it. And if something is fairly valued, you hold it. Am I please clear with this? Am I please clear with this? Sir, what about this note? We will refer to it later on. For now, you just need to understand this much part of it. Done? So in our case right now, one second. Huh? Cool. In our case, if you realize everyone, right? Since market price is more, the share is overvalued. What course of action will you take? Sir, we will sell the share. That is what the thought process we have framed for part X. Part Y, you will have to do at your own. Such an easy question. Question number 4th. Question number 5th. Again, a question homework. You'll have to do it in your notebook entirely at your home. It's not a big deal to do, right? Just that you have PBT. Then do you people agree that from profit before tax, if you deduct the tax rate, you will get the amount of PAT? When divided by the number of share, you will get EPS, because if there is no preference dividend, PAT divided by N also works. So EPS you will have with the help of retention ratio and the ROE, you can calculate growth rate. But sir, ROI has been given. In the absence of information, can I say that my capital has only equity? There is no debt, involved. All I have is equity, which means, can I say the rate of return on investment is the same as rate of return on equity, because all my investment has only equity, everyone in the class, hence I will assume ROI to be ROE, right? And equity capitalization rate is also called as, for your information, K. So equity capitalization is K, ROI can be assumed as ROE, and that's how the question number 5th is such a basic question to be done at home. Done. Question number 6th is a good question. Again, an extremely easy question. Let's do it right away. So among 6 and 7, 6-1 is more difficult. So let us do the question number 6th right away. And before doing that, do you feel like taking a break? What do you say? Without any pressure of being informed to your parents, do you feel like taking a break? What do you say, everyone? Quick. Come on. Some people say yes, some people say no. Come on, everyone, quick. And some people, I think, just by listening to this have started taking break at their own. Fine. So a very quick 5-minute break. Let us, everyone in the class, meet back at 5:30. All right. Let us, people in the class, meet back at 5:30. After which start proceed with further questions to be solved in the class itself. But when you come back, please come back with a fresh mindset. Bye. So all right, people, do I have you all back in the class, please? Everyone, come on. People, do I have you all? Come on. Shall we get started with it again? So, question number 6, we are doing it right away in the class. Extremely easy question, in fact, even if we don't do it. So, basically, the objective is not doing easier question and the focusing on the questions which are tricky and smarter. Okay, but anyways, to start your rhythm, we can do question number 6. Yeah. So, Jahan, congratulations. Finally, you have changed your name to Jahan. Great. So, all right, everyone, share of Voyage Limited are being quoted at a P ratio of 8 times. 1 second. Share are quoted at a price. How are they quoted at a P ratio? They mean to say that whatever is the EPS, relative to EPS, the P ratio is quoted 8 times, which means the market price is quoted such that the P ratio is 8 times. Okay, the company retains 5 per share, which is 50% of its EPS. 1 second. Company retain rupees 5. 5 rupee is 15% of EPS. Then how much would be 100% of the amount which is EPS? Sir, 5 divided by 50%, this is the amount of EPS of rupees 10. And P ratio, they are saying that P ratio is 8 times of the earnings. Sorry, P ratio is 8 times, which means MPS is equals to EPS into P ratio. Do you agree? Right? Which means MPS divided by EPS if is equal to P ratio, then MPS is equals to EPS into P ratio. So EPS is 10, sorry, EPS is 10 into P ratio of 8 times will give me an MPS of rupees 80. So even this one is fine, cool. You are required to determine cost of equity of the company if market expect a growth rate of 15%. Everyone, the calculation of case, you had multiple priorities. The first one was CAPM. Are you able to apply CAPM? No, RMRF missing. Second priority was Gordon's model, which is D1 divided by P0 plus G. Are you able to apply this particular? Answer is yes or no. Do you think you can apply this particular formula of calculating K? The answer is yes. Sir, if my retention ratio is 5, if my EPS is 10, then dividend is also 5 divided by price of 80 I just calculated, and the growth rate of 0.15 examiner says it is. So 5 divided by 80 plus 0.15 is 21.25. Everyone in the class, the answer of K first part gets done. Quick, I need a validation. Are you people here? Agreed? Disagreed? Come on. Are you people agreeing to it? Come on, come on, come on, quick. Yes. Was there everyone a blank screen kind of a thing for a second? I actually did a refresh from here just to try it. Was there a blank screen or something for a second, everyone? संदीप आस्किंग फास्ट ट्रैक बैच आएगा क्या नियर फ्यूचर में? संदीप आएगा, बट नवंबर 24 की एग्जाम के बाद आएगा लाइव. नो, कूल. Others in the class, proceeding with the next one, you need to calculate the indicative market price with the same cost of capital if the growth rate changes to 16%. 1 second. DPS continues to remain 5, but growth rate changes to 6% and the cost of capital remains 0.2125. Right? 0.2125. So same dividend, same cost of capital, growth rate changes. What is the price? Revised intrinsic value they are asking as per Gordon's. Sir, easy, manageable to do, right? 0.2125, 0.2125 minus 0.16, right? Divide equals to into 5, give me 95.23. Everyone in the class, sorry, 238, 24 on a rounded off basis as the revised market price, right? When they say indicative market price, they mean to say intrinsic value. They mean to say intrinsic value, right? The last one. The market price we need to find again if cost of capital is 20% and the growth rate is 18%. Extremely easy. Come on, you'll have to do at your own. Because dividend is there, K is there, and the growth rate is there. What else do you need? 5 divided by 0.02. Everyone in the class is 250 as the share price. This is not a CA final level question, although it has been asked in the exam, but it doesn't deserve to be in the exams of CA final. Okay, Gopi, do you remember? Gopi has asked me a very good question. He says, sir, why didn't you do 1 divided by PE? Gopi, these are the preferences in which KE should be calculated. These are not the options of any of which you can apply. If this data is there, your first preference should be this. However, if you think this cannot be applied, then only you go to the next one. Second preference is this. Only if second cannot be applied, you move to the third one. Are you please understanding what I'm trying to say? Please. Gopi. So come on everyone in the class, 6th question gets done. 7th question is a homework question, easy manageable question, right? Question number 8 is a good question to be done in the class. Come on. So come on people, I just need your energies for the next 25 minutes. That's all I'm expecting. Are you people awake, alive for the next 25 minutes? Come on, everyone. Done. Do I have your energies, everyone? Yes. All right. Great. Thank you so much. So you have to please observe the smile. How big a smile I have when you people respond to me. So if you really want to me be smiling throughout the lectures, you'll have to be please continue to respond. Okay. Sir, X Limited just declared, everyone in the class, X Limited just declared a dividend of 14. What do I call it? Come on, come on, come on. What do we call it? Call it DDD0. Mr. B is planning to purchase the share. All right. In anticipating, matlab estimating, guessing the increase in growth rate from 8 to 9. He is thinking the growth rate will increase to 9%, which means now the growth rate will be 9 for me. Okay, which will continue for 3 years. For the next 3 years, growth rate will be 9. He also expects the market price to be 360 after 3 years. Come on, come on. People, on the basis of information given, which category do you think the question goes to? Finite period or indefinite period? People, finite period or indefinite period? What do you say? That which two things which I'm talking about? This is for a definite period of time, right? A limited period of time. My bad, I used the word finite. Okay, so this is definite period or indefinite period? What do you think? Come on, question again. Sir, the answer is it is for a definite period of time. Question clearly says growth rate will continue to be there only for 3 years. He'll also expect the market price to be 360 after 3 years. which means examiner has not given to you the growth rate till infinity. Also the examiner says you will receive 360 if you sell it at the end of third year, which means for you the present value will be dividend of first year, second year, third year, and also the selling price at the end of third year. That's all you need, people. That's all you need. Are you clear, sir? So you are required to determine the maximum amount Mr. B should pay for share if he require the rate of return to be 13%, right? So the maximum amount he should pay, in the sense maximum amount he would pay is the fair value, which is nothing but intrinsic value. At max, how much I can pay for the share, its intrinsic value, not beyond it, because beyond it, if the market price is there, I call the share to be overvalued. If beyond that is the market price, I call the share to be overvalued. And everyone, I must say intrinsic value is present value of D1, D2, D3 and the present value of sales price at the end of third year. Correct? Correct. So, sir, what are the dividends for the next 3 years? Examiner has given to you the future value factor at the rate of 9%, 1, 2, and 3. If the dividend of 0 point is 14, dividend of first year will be 14 into 1.09. 1.09 into 14 is 15.26. Second year dividend will be 1.188 into 14, which is 16.63 on a rounded off basis, right? If you want to consider it till 3 decimal points, if it's fine. If you want to consider it till 2 only, it is again fine. Okay. Third year dividend will be 1.295 multiplied by 14, which is 18.13, plus the selling price of 360. That's how your total cash flows are. All these three cash flows I will discount manually. How do you discount? By multiplying the present value factor at the rate of 13%. So present value factor at the rate of 13%, 0.885, 0.783, 0.693. Always use the factors which examiner give to you. People, let's do this calculation on the calci. 15.26 when multiplied with the present value factor of 13% for 1 year, right? It is 15.26 multiplied by 0.885 m plus. Next one, everyone on the calculator with me, otherwise you will have to struggle at home. That 1 hour of home will convert it to 3 hours, right? 16.63 when multiplied by 0.783 m plus and 18.13 plus 360 when multiplied by 0.693 m plus, give me an answer of 288.5704, which means 288.57 on a rounded off basis. This is the maximum amount you can pay. Once you all have the answer on your calculator, say done on the chat box. People, whenever you have the answer to this question, say done on the chat box, please. Come on, quick. Done. Next one. Who's sending these hearts to distract the teacher? It looks so awkward from the other end. When I'm in such a serious mood, when all my brains are working and no drop of blood is reaching to my heart, and I see some hearts flying here and there, which means that they look good, but that doesn't match with my present state of mind. I mean, that is all different. My present state of mind is all, stuck in something. And I feel these hearts blowing from here to there. All this I mean to say, how can you people think of sending hearts at this point? All my blood is literally consumed in my brains. Okay. Anyways, I think is it the problem of, well, you would be able to relate to it more. Life of a single student in a CA course. No? The deadliest combination, single plus CA. Shall we? People with that, proceed. So done. That's a myth. True. Come on, everyone. More general in CA. True. So I think if you're a CA, the next question should never be, so for example, you go for a date, right? Or when suppose you meet a girl or a boy. If you somehow get to know that she is a CA or he is a CA, the next question should never be if you're single, right? And that's not an opportunity to you that he or she would surely be a single. That's a problem that despite they being single, they won't, are ready for you. They won't be ready for you is what I mean to say. So coming back, people, kindly put aside the pain you have. Keep your emotions in control. Come on, come on, come on. I can understand the pain, but you'll have to keep it for the next 3 months with you. Everyone. Because I know there are some students who are so single, who have been so single, just like me, that they never knew that the otherwise of it exists as well. So they say, what is single? This is the life. Now, what is the new normal? Okay. So those who don't know, there is one side of it which is called as relationship. I think you never, I guess you have heard it at least. Something called as relationship. I hope. So well, if not, give your life a time of 3 more months, and once you become CA, then I think you get a chance. Come on, people. So well, jokes apart, people in the class, come on. The maximum price examiner asking, kindly come back to the point where the life for us is the maximum price Mr. B will be willing to pay for the share if he is of the opinion that 9% growth rate, everyone in the class, this 9% growth rate can be maintained indefinitely. Everyone, the examiner switches from definite to indefinite period, and he says that 9% growth rate is now maintained indefinitely and you require 13% rate of return. 1 second. I will everyone in the class, everyone in the class, you need to, people, you need to do D1 divided by P0 minus G. D1 divided by P0 minus G, which is D1 I don't have. Sir, I don't have D1. Then what do? You do D0 into 1 plus G. That is the clarity I need to give to you once. Please hold on for a minute. At this point, I need to take you to the OutNotes once. Miral, 1 second, I'll reply to your question. 1 second. Sir, my actual formula is D1 divided by K minus G. This is the actual formula I apply. However, if in case you find that, sir, the D1 is missing, then only you can apply this formula of D0 into 1 plus G divided by K minus G. The official formula is this, not this. Sir, why are you telling us this so specifically? People, please imagine. If I teach you this formula as the prime formula, first it is misleading. And second, when you see D0, you might feel that, okay, the first cash flow being discounted is D0. The answer is no. The first cash flow being discounted is D1. This is just a possibility that when D1 is missing, I can calculate D1 like this, which means that the first cash flow being discounted is D1. The growth rate which matters to me is from D1 to infinity. D0 has nothing to do with it. Am I strictly clear on whatever I was trying to explain, everyone? So now in this case, since I have D0, I can use D0 as D0 into 1 plus G divided by K minus G. Sir, 14 into 1 plus G is 14 into 1.09 divided by K is 13, G is 9, which is net is 4% divided by 0.04 is 381.5 as the value of share. Done? Come on, next. Sir, the price of the share at the end of third years. Oh my God, what a question. What will be the price of share at the end of third year, at the end of 3 years, if growth rate of 9 is achieved, assuming other conditions same as above? What a beauty. They are asking you to calculate price at the end of third year. And do you people with that realize it should be everyone D4 divided by K minus G? If D is 1, price is 0. If I need the price to be 3, I need the dividend to be at the end of fourth year. Come on everyone, please. So dividend at the end of third year, I had calculated 18.13. To this number of 18.13, can I everyone multiply 1.09 to be my growth rate? Divided by K of 13, growth of 9x, the examiner says same as second part. And that is how you calculate the price at the end of third year. People, could I explain to you? Could I explain to you whatever was going on? So do this calculation. D3 is 18.13, everyone, into the growth rate of 1.09 will give me D4. D4 directly is not available. Divided by growth rate and K remains same as B, which is 13% K, 9% growth rate, divided by 0.04. Everyone is 494.04 on a rounded off basis. Come on, come on. Did you people in the class get this answer? Everyone in the class, did you get this answer? Come on, quick. What do you say? What do you say? Yes, no, settled or not settled? Usha Rani, yes. Purshi, I think you are lagging in this lecture because when I was not joking at all, you sent this smiling, laughing emojis, which means either you understood the joke late or maybe you heard it late. So, Meeral, I'm not single now. I was saying when I was a student, I was single. Okay. Great. Shall we, with that, move to next question? People in the class. Question number 9th, everyone. Question number 9th, everyone. Sir, we can't take D3 as it is. Obviously, na. Chandan, please understand it on the timeline. Chandana, sorry. When I say D1, dividend at the end of first year. D2 is dividend at the end of second year, and D3 is dividend at the end of third year. Now, D3 is dividend distributed at the end of third year. When I need P3, I need to use D4 divided by K minus G, right? That is what the point is. Cool? Done, Chandana. Meeral, come on, this is not my personal investigation. We need to proceed on. Focus on something more important. Question number 9th, a challenge question. What is challenge question? Let me tell you. So everyone, do you know what is my objective with this batch? I don't know how much of it is executable because everyone, I don't know how much of it is executable because this I surely do with all my regular and faster people. That I want all my student, be evolved, which means after this batch, they should not only be capable of solving the question which they have already seen, but also the newer question. And that can happen only when you have the conceptual clarity, and that can happen only when you have a thought process of your own. The moment you learn how to think, you will be able to solve even the newer questions, right? So 9th question, I'm changing my mood, is not purely a challenge question because the language is not clear. But at point where I feel, at point where I find that this is something tricky, you should try. People, try to take that challenge and give your best to solve that. The reason I will explain the moment we have the challenge question. right? How will you evolve out of it? I will explain it later. Okay, question number ninth right away in the class, people. There is this company NM Limited aspiring to enter into capital market in 3 years' time. After 3 years, it will enter into the capital market, which means it will come up with its IPO. Okay. The board wants to attain the target price of 70 at the end of 3 years. People, what is this question? Examiner has given to me a price of 70 at the end of 3 years. The present value of share of 52.03 has already been given. Okay. The dividend is expected to grow at the rate of 15% for the next 3 years. What is the dividend now? I don't know. But whatever it is, for the next 3 years, right, it will grow by 15% every year. Okay, cool. Right, the required rate of return is also 15%. So all these dividends at the end of year 1, 2 and 3, right, and the price, the selling price at the end of third year, all these cash flows are to be discounted at the rate of 15%. You are required to calculate the amount of dividend. Wait, you are required to calculate the amount of dividend to be declared in the base year. So please understand what the question is trying to say, people. At the end of first year, second year, third year, there will be some dividend, right? When all these dividends are discounted, right? And along with this, when the selling price is discounted at the rate of 15%, you get a value of the bond, which is value of the share, which is already given as 52.03, right? The selling price, my bad, I'm so sorry. The selling price has already been given as 70. This dividend, the dividends are missing. When all of this are discounted, the price is 52.03. I need to back calculate this dividend is the question. Which means this particular dividend, if I assume D, which is the dividend of base year, then can I say my dividend of first year will be 1.15D? Second year dividend will be plus 15%. So 1.15D plus 15% is 1.3225D. The dividend of third year will be further plus 15%. It is 1.5209D. Did you, everyone in the class, understand the point I'm trying to make? Come on, I just need a validation of yes or no. If I get a validation, I'm all sorted. All the live people in the class give me a response. Are you able to imagine what I'm saying? So do you agree if I don't know D, I can assume D and try to discount all the dividends and the selling price, and the present value should be equal to 52.03. Cool. So please look at the solution. Look at the solution. Sir, dividend of first year into the present value factor, discounting factor of first year. Dividend of second year, which is D0 into 1 plus G to the power 2, adding growth for 2 years, multiplied by the factor of present value factor of 2 years, dividend of third year into the present value factor of third year, and spot price of third year into the present value factor of third year should be equal to the value of share at 0.0. Agreed. Now, if you think common sense, do you realize to your D0 to this amount, everyone, you are adding the growth rate at the rate of 15%, because as the examiners say, growth rate in dividend is 15. So you are compounding it by 15% and you are again discounting it by 50%. Can I say the net effect is mathematically zero? Similarly, you compound here at the rate of 15% two times, you discount it back again at the rate of 15% two times, the net effect is zero, and similarly the net effect is here is zero. Did you understand the last point I'm trying to make? If you are able to think it this way, there is no problem if you are unable, if you don't want to think this way, people. So I will say I will do it naturally, right? I don't do this shortcut, but I will do this naturally. So D0 into 1.15 into this present value factor, D0 into 1.15 square into this present value factor, and D0 into 1.15 cube into this present value factor. Basically, the D1 and D2 and the D3 that we had calculated few minutes back, it is the same thing. So let me multiply the factors. The selling price of 70 also multiplied with third year factor, and all this is equal to 52.03. Everyone in the class, do you observe that in this entire equation? In this entire equation, I have only one number missing, which is the number of D0, nothing else. So please be here with me. We will try to figure out how to solve it. Come on, come on, come on. Everyone, please be here. Sir, please, if you have this equation written down with you, let us try to imagine how to solve it entirely on the calculator. Sir, if I have this number somehow, can I bring it here towards the left and deduct it from 52.03? Right? Can I do so? So let's do it. Let's do it. Sir, 70.6575 is equal to, sorry, 70 multiplied by 0.6575 is equals to 46.025 on my calculator. When I bring it here, it become a negative number, so I add a negative sign before it. Put a negative sign before it, and people deduct it. Putting a negative sign is basically deducting it from 52.03. So add 52.03, which will mean 6.005 on your calculator. Right? This much we are settled. Put it to M plus. Right? So this terminology gets sorted, this one gets sorted. On my calculator it is 6.005. Now let us multiply the two number. Sir, two number is 1.15 multiplied by 0.8696 is 1.0004 rounded off to 1. So this is 1. Let's multiply these two numbers. Let's multiply these two numbers. Everyone, 1.15 into equals to square multiplied by 0.7561 again gives me 0.9999 again 1, and even this one when I do 1.15 into equals to cube multiplied by 0.6575 gives me again 0.9999, which is 1. So 1 D0 plus 1 D0 plus 1 D0 is equals to 6.005. So can I say 3 D0 is 6.005? So a combination of imagination and calculator when you do, you would be able to solve the entire thing on the calc itself without wasting a time to write this down. Right? So 3 times D0 is 6.005. So D0 is on a rounded off basis to everyone in the class as the amount of dividend of base year. Which means this question was simply trying to back calculate dividend from the value of from the price which is given. Generally dividend given, price calculated. This time price given, dividend back calculated. Requesting your responses, your comfort on question number 9, please. How much everyone in the class is your comfort on question number 9? Come on. Quick, yes or no? Understood? Done? Great. So I think if I teach you more, you will be. So 10th question, I don't think we will need to do. A question not in the study material, asked only once in the, not even asked once in the exam, is the question only from MTP. No RTP, no study material, never in the exam. Question number 10th, tomorrow onwards I'll figure out whether we should do it or not. 11th we will need to do. So all right, cool. So at this point, I think we should stop the lecture. We should call it a day. We will meet back again on Monday, which is on at the same time, 4 to 6 p.m. Cool. Everyone in the class, any other doubts or queries that you want to ask? People, as a whole, what do you say? Did the lecture make sense to you? Was it, are you settled, satisfied with whatever has been taught? People in the class. Great. Come on, everyone. Yes. So great. So all right. I really hope the lectures are making sense. Thank you so much everyone for being here live, okay, and watching it recorded, both of you. Great. So stay tuned on Telegram. All the updates and everything will be there on the Telegram channel, right? You don't have to worry about anything. If you people don't get the links, I will take it on YouTube, but we won't miss the lecture. It is only after all of you get the link, we will do it on the content browser. Done. Next class on Monday. Bye everyone. Take care. Thank you so much. I'll see you back on Monday. Make sure you use this weekend to complete everything in the notebook. All right. Take care. Bye bye bye. Okay. I'll see you.